Hey everyone, this is Andy Michael, Portfolio Manager with Seven Springs Wealth Group. Today I'm excited to announce our new outcome-focused video series, and today's topic is inflation. Now when we think about how we invest for portfolios, we want to invest with the outcome at the focus of what we're doing. And so we want to clearly define the outcome, we want to invest with purpose, and we want to measure that outcome for success. And so the three big outcomes that we're trying to solve for are preservation, preserving our capital with high degrees of liquidity, income, trying to generate high cash flows and good yields from our investments, and growth, compounding our returns over the long run. And so today we want to talk about how inflation impacts those outcomes we're trying to solve for and what we can do about it. If we look at where inflation is today, the latest report we saw from the CPI in October was 6.2%. This is very high compared to historical norms. Now going forward, what we see the market telling us in this chart down here, the 10-year break-even inflation rate is at 2.61%. So that's showing us the market is projecting a 2.6% inflation rate over the next 10 years. So that's lower than where we are today, but still higher than the 1.5–2% inflation that we've seen over, say, the past 10 years. Let's look at the real yield we can get on our investments when we think about the impact of inflation. If you were to buy a 10-year treasury bond today, hold it for 10 years, experienced that 2.61% inflation, you would have a real return of negative 1.1%. So backing out the inflation, this bond would actually be losing purchasing power over the next 10 years. So as you can imagine, that creates a lot of problems when we think about investing, especially when there's no safe rates available in the market. Look at a 1-year treasury bond offering 0.2% interest. Or how about a 10-year treasury bond? 1.6% interest. Let's look at a CD. So I went to a major national bank's website, we wanted a 13-month CD with $10,000 to $100,000 investment. We get a 0.05% interest rate. That's almost insulting. It's like a server getting offered a quarter as a tip from a patron. Oftentimes that server's thinking, you know what, just keep your quarter. I don't even want it. That's how I think about a 0.05% savings rate on a 13-month CD. We look at bonds, short-term bonds. You have to go all the way out to 3 years on a BBB corporate bond. So investment grade, but the lowest of investment grade available, just to get a 1% return. And we just saw that inflation is projected at 2.6% currently in the market. So what we know is getting a 1% return on a 3-year bond is likely to have a negative real return in purchasing power terms going forward. So there's no free lunch out there. I think that's one of the big points that we want to take away from this video today. You know, we're going to have to do some type of trade-off to get some type of goal, some type of outcome that we're after. So we have 5 outcomes that we've defined today that we want to run through and talk about the trade-offs and solutions that we see for each. So the first one I want to talk about today is principal protection and liquidity. So for this outcome, we're trying to think of something that's not going to lose any or very much principal at all, not going to fluctuate, not going to have a lot of volatility or risk, and we want it to be very liquid so we can access our money at any point in time, access to it next day or next week. And the trade-off for that is return. As we just saw in those charts, you know, short-term bonds are offering less than 1%. Cash, you know, a CD is offering 0.05%. So there's just not going to be a lot of return in this category. The solutions to do this, though, are high-yield savings accounts. You can get an online savings bank with FDIC insurance and get around 0.5% interest, still better than that CD we just looked at. And short-term bonds are still a solution here for that bucket that we just want to keep principal protected and liquid. We're going to have to exchange getting high returns on that bucket. The next outcome we want to talk about is getting principal protection, trying to get a little bit of return. So the trade-off for that this time is going to be liquidity. So there are a couple of solutions out there that we're looking forward to diving in deeper details in future videos, and happy to have conversations with clients about. But one of those is Series I savings bonds from the Treasury. They offer attractive interest rates, principal protection, but they don't have that same liquidity component to them as, say, a savings account. Annuities, another option that offer some principal protection. They can offer good income streams, but again, you give up a lot of your liquidity by investing or utilizing a tool such as an annuity. The next one we're going to talk about is return and liquidity. So in this bucket, you're saying, hey, I do want to generate some return. I want something more than 1%, but I also want to be able to access that money if and when I need it. And so what's the trade-off here going to be? It's going to be principal protection. We're going to have to take a little bit of volatility, a little bit of risk in order to access return with liquidity. So some solutions there are high-yielding bonds, preferred equities, which are more secure in the corporate structure than common equities. We have stable dividend-paying businesses such as utilities. We have cash flow producing real estate. These assets can offer a little bit more liquidity than what we just looked at before. They can still offer some good returns, some good cash flows and yields, but you are going to have to trade a little bit of volatility and a little bit of that principal protection in order to get it. The next one is being fully invested with liquidity access. So in this bucket, we're really talking about having a portfolio that's fully invested, but then having something like a line of credit as a reserve that you can access should you need it. This helps the portfolio to be more aggressively invested instead of having everything on some of those options we talked about before, being more conservative, less return generation. The trade-off here is that you're going to be increasing leverage if you use that line of credit. So you'll have a more aggressive portfolio on one side, you'll have leverage by using that line of credit on the other side, so that will increase the overall risk in your portfolio. But this is a great tool in the toolbox for being able to access capital if you need it, while still being able to maintain a fully invested portfolio for long-term growth. And really the last bucket here is compounding growth over the long term. The trade-off here is going to be having mark-to-market volatility. So think about owning a high-quality portfolio of global diversified businesses. It's going to be getting mark-to-market every minute of every day that the market's open. So there is that risk of short-term volatility, of downside volatility. But we think in the long run, this is the best way to fight inflation. Stocks have historically outperformed inflation and generated real returns over the long run. And so we still think this is the most important bucket to be investing for when we're thinking about risks such as long-term inflation. I think it's really important to think about having use of all of these buckets in some degree or fashion. So this isn't a which one should I do? Should I go all in on having a savings account and short-term bonds? Should I go all in on only having a long-term growth portfolio? The answer is you're going to need some of all of it in order to truly be able to have that liquidity, be able to generate some return, have a little bit of principal protection on one side, but then be able to grow your investments for the long run when we're thinking about inflation. So that's it for today. We're looking forward to having future videos coming forward and up soon. And so please reach out with any questions in the meantime, and we look forward to talking soon.